Hello, December is in progress, and of course, the speculations on Twitter, or X as it is called today, as well as other media and social platforms, continue to go around. I am Jimmy Lapping, a psychologist and statistician with loads of interest in research, including the financial markets. And since a week or six ago, I also have my own YouTube channel. Yesterday I shared a series of videos on the S&P 500 and three European large cap indices, AEX, DAX 40 and CAC 40, in search for the Santa rally. And I now combine 30 years of data from the AEX, DAX 40 and CAC 40 to show that there is no convincing evidence in favor of a Santa rally, and if it ever existed, it seems it ceased to exist years ago. Here you see the pattern of daily percentage gains or loss for each day in the month of December for the three indices that I mentioned previously. For the years 1993 all the way until last year, so a total of 30 years of data, which means nearly 1,800 trading days of data. And as you can see, the differences between indices are so close to non-existent that one would need a microscope to see them. And here I compare 8 different models in terms of R squared, or the percentage of variation in daily performance explained by the model, as well as Akaikis and Schwartz Bayesian information criteria, abbreviated AIC and BIC. While higher R squared values are better for AIC and BIC, lower values indicate a better model. So for the data at hand, the fifth model is the model to be preferred. This is the model which states that there is a difference in daily performance between the first 19 days of December and the period from December 20 until the year's close. This model explains only about 0.8% of the variation in daily performance. Yet it is preferred by both information criteria because we have a sample size of nearly 1,800 cases, which is quite a lot and means that even small effects like this one can be detected. So what does this effect look like? Here we see the mean, median, standard deviation, as well as the minimum and maximum performance for each time period, and below the histograms to show how small the differences between the two parts of the month are relative to the differences within each part. Now, since we have such a large sample and a small effect, we can use the two one-sided test, or TOST, independent samples t-test, which is available in open source statistical programs such as Jamovi, and allows to test whether the 90% confidence interval around an observed difference lies within boundaries that we can define as relative equivalence. This is to say that although the difference between parts is not zero, or may not be zero, it may be so small that we may as well call the two parts relatively equivalent, or in plain English, about the same. And what this test indicates here is indeed sufficient evidence in favor of relative equivalence. And here you see from a different angle what that looks like visually, and we can conclude that even if there is such a thing like a Santa rally, it may be so small that it is not worth preparing for. But instead of looking at the daily percentage gain or loss, what about the percentage gain or loss over the whole period of days 1 to 19 versus days 20 to year end? After all, even sustained small gains on a daily basis can together create a substantial gain over a longer period, even if that period is only 1 or 2 weeks. So let's investigate this further. Here I compare 5 models on the same statistics as before. The first is the null model, which states no differences across the month. The second model, parts, states that there is a difference in the average performance between parts over the 30 years we are including in our analysis. The third model, overall, splits the last 30 December months for the three indices in two parts, no? So in total, actually three indices, two parts and 30 months, which is 30 times 3 times 2. There are 180 data points here. And well, this data set is split in years in which December overall resulted in a loss, in years in which December resulted in no loss but a maximum gain of 2.5%. And in years in which December resulted in more than 2.5% of gain. Next, the fourth model includes both main effects of parts and overall, and the fifth model also includes the combined effect or interaction effect of parts and overall, which indicates that the difference in average performance between parts is not the same for bad, satisfactory, and good December months. And the model that wins here is that final model, which includes the interaction. So what does this pattern look like? Here we see a chart and statistics for this pattern, and we see a few things. First of all, in times when December overall resulted in a loss, which happened in about 28% of the cases, there is no evidence of gains during days 20 to 31. Although the second part, that of days 20 to 31, does perform much better with a difference of over 4 percentage points relative to the first 19 days of the month in these months when December goes down. Basically, these months tend to show just a poor performance in the first 19 days of the month, and an average performance really around 0 in the second part of that month, as is also indicated by the 95% confidence interval for down months for days 20 to 31 in the month, an interval that includes 0. Second, in the times when a model resulted in, when a month, December, resulted in more than a 2.5% gain, which was the case in about 47% of the cases, both parts perform about the same. Which is to say that there is no such a thing as a Santa rally starting the 20th of December, but simply a continuation of the positive trend established in the first 19 days of the month. And only in the remaining about 25% of the cases do we see some evidence of a superior and positive performance during days 20 to 31. With an average increase just over 1.5% in that second part of the month. So to conclude, even if we split in days 1 to 19 versus 20 to 31 and focus on the percentage gain or loss in each period, we find no evidence for a consistent Santa rally. During bad months, the Santa period does not tend to be particularly good either. During clearly positive months, which account for almost half of the cases, both parts perform about the same, so there is nothing special about any of these parts of the month. And only in about a quarter of the cases, when December is neither bad nor particularly good, there is some tendency of a somewhat better performance in the second period. But is there any evidence of an increasing or decreasing trend in the Santa rally over time? Because thus far we have not made any distinction between the earlier years and the later years in this period from 1993 until last year, which is like treating the magnitude of the Santa rally, 0 or not 0, as something constant across the years. So let's investigate this possibility as a final step of this study. I compare 5 models, of which the first 2 are the same as in the previous comparison, just that now in the other 3 models, the overall monthly performance, which was before a categorical variable with 3 levels, has now been replaced by year to allow for the study of a time trend over this 30-year period. And we treat year here as a linear predictor. So here there are two criteria which are a little bit divided over what is the best model. On the one hand, the BIC prefers the main effects model, whereas AIC prefers the full factorial model. Now, since the sample size in this comparison, like in the previous one, is not one based on, it's not 1,800 data points, but it's only 180 data points. And the full factorial model explains about 1.5% more than the main effects model. Let's have a look at what the full factorial model tells us. And here it is. Basically, the full factorial model indicates that the superior performance in the second part of the month, starting the 20th of December, relative to the first 19 days of the month, well, has slowly disappeared over time. And in the table below, you see simple effects tests for each of the two parts, which indicate that the slope for the first 19 days of the month is not significantly different from zero over time. Whereas for the second part of the month, we see a tendency of a declining performance over the years. In other words, it seems that Santa has been shrinking to zero. Or, in plain English, if there ever was such a thing like a Santa rally, it may have been a thing in the 1990s and early 2000s, but even in that case, it seems we have cancelled it. So as I said in one of my videos that I shared yesterday, before you make decisions anticipating on a possible Santa rally, I invite you to do your own research with the index that you are interested in order to see if the picture is any different from what you've seen in this video. But based on the analysis that I've done with these indices and as well as other indices, I very much doubt that you are going to reach different conclusions for your index. Having said, that is it for this video. I hope it is useful. And if you have any ideas or suggestions for future videos that you would like to share, please leave a comment below this video or just drop an email using the email address shared below this video. Thank you very much for listening. Have a good day and see you soon.